S-Corps don't always save you taxes despite what you read on the internet. Here's 5 downsides they don't tell you about when you turn your business into an S-Corp. One is the tax savings you get from the S-Corp are from paying less into Social Security and Medicare taxes, which means the less you pay into Social Security, the less benefits you get when you retire. Maybe not a big deal for the younger generations, but it's a fact. 2, the maximum amount of income you can defer using a retirement account like a SEP or a Solo K is generally less when you use an S-Corp than an LLC. This is because the limits under a sole proprietorship, single member LLC is 20% of your entire net income, whereas with an S-Corp, it's 25% of the W-2 wages you pay yourself, which is generally a fraction of your net income, call it 50%. So would you rather have 20% of 100 or 25% of 50? Simple math. 3, if you ever have business partners, you have very strict rules to follow related to pro rata distributions, which means distributions according to your ownership percentage, the exact same amount. If you disregard this rule, the IRS can turn your business into a C Corp at any time, which will in turn lead to much higher taxes. 4, if you take on a bunch of third-party debt and then you pull distributions from the business, you could do what's called exceeding your tax basis. And if you do this, you have to recognize the excess distribution on your taxes as a gain. It's basically turning loans into taxable income, which is absolutely not what you want. 5, if you do business in places like NYC, Tennessee, Washington, D.C., you'll end up paying more in taxes with S-Corps because they have a tax on S corporations. You also never want to own real estate in an S Corp. And there are even more downsides that you need to consider before you turn your business into an S Corp. So if you're thinking about turning your business into an S Corp, make sure you consult with the CPA.